Hello, everybody. So in the last video, we learned about earnings per share and PE ratio of a company. And we talked about the earnings. The earnings that we consider at that time is uh, the total profit of a company subtracted by the dividends that we have paid to the shareholders. So we saw about this thing that how to look at the EPS in screener, how to look at the PE in screener. But what's a good number for PE ratio to consider for a company? Generally, the lesser the PE of a company, the better it is. Why? Because basically it gives you how expensive is the company right now. If the company is at a PE of 1, then probably you'll be able to get back your earnings within 1 year, with your investments within 1 year through the earnings of the company, figuratively. But if the company has a PE of 100, then it will take you 100 years, assuming everything is linear, then it will take you 100 years for your investment to be back. Generally, a PE of 20 and lesser is considered good in the current market. If it is lesser than 10, even better. Lesser than 20, look at the other things also. Greater than 50, probably you should be looking at other ratios, and if the other ratios are exceptionally good, then probably even then I would say that reconsider your investment decision in a company which is PE is 15 and above. For example, one of my friends came to me. He said, hey, because of so and so policy of the government, the metal exports have started, and a metal company from Tata Group is going to go really high in its share price. One look at the PE ratio, and the PE ratio was 85. It means the company share is already very expensive. No matter how much it is able to export, how much it is able to grow, the current share price is very expensive for the asset. Should I be investing? Maybe I should be waiting or doing more deep analysis or going to your financial investor, because I cannot directly give you a recommendation for buying or not buying. So maybe you can see it. But 85 PE is really high for a share. Now we will be talking about two more ratios, that is dividend payout. We touched upon it, dividend payout. Let's say dividend payout for a company is 25%. It means for every $100 it makes, it gives $25 as the dividend to the investors every year. That is dividend payout ratio. Another ratio that we'll be talking about is DE ratio, debt to equity. Your friend comes to you, he says, person A is very rich. He is having $7 million. And the other person is just having $3 million. Person A is richer than person B. You just ask him a question, has he taken any debt? Once you find out, oh, he has taken a debt of $9 million, $10 million. And person B, has he taken any debt? He has taken a debt of $1 million. Then the actual worth of person B is that he has net $2 million with him. Person A is having net negative $3 million he has to pay. Who's richer? Is person A richer or person B richer? Apparently, person B is richer. Same is the case for the companies. Debt to equity ratio gives you an idea about how much are the liabilities of a company, how much debt they have that they have to pay. But there are two terms, debt and equity. So every company raises money or gets assets in the form of cash with different tools. One of the tools is it can go to the banks and can say, hey, can you give me a loan? And in lieu of this loan, I will give you some interest every year. Let's say that taking of loan is called debt. That he takes a debt of $100. There is another tool that the company can use for raising the money, that is equity. I give equity shares into my company to the normal people. And if every share is $1, let's say I have issued 100 shares of the company, then they will get, if everything is bought, then they will be able to raise $100 with that. So we are looking that a company has $100 because of the loans it has taken, debt it has taken, and $100 because of the equity tool or because of the shares that it has issued to the shareholders. Then debt to equity ratio will be 100 divided by 100, that is 1. That how much financing a company is doing through the debt tools, through the loan, for which it have to pay certain interest from the pocket. And how much financing it is doing with the equity tool, for which it doesn't have to pay any interest. Generally, a debt to equity ratio of lesser than 1 is good. That company is using more of its equity cash for financing its activities, for doing its operations, rather than taking loans. Now, I'll tell you an incident that one of my CA friends, he came to me and he said, there is a very famous metals company in India. It is giving a lot of dividend. It gave 100 crores of dividend to its shareholders last year. And the share price is going like anything. It is growing like anything because everybody is looking at the dividend payout percentage of the company. He said, the dividend is really great. I'm going to invest in this company. See, he looked at only one indicator. Once you start completing the pictures, suddenly I saw the debt to equity ratio was 2.5. Just check the debt to equity ratio and how they are raising the debt. Every year they are taking a lot of debt. They gave 100 crores of dividend. I was just wondering, their cash flow is negative, their profits are negative, sales are going down, ROCE is very bad, ROE is very bad, but how come they are paying so much of dividend? It's because they were raising 300 crores of loans every year. They are taking debt of 300 crores every year. Now, somewhere this bubble will burst. They keep on taking the debt. They are not making any money. They keep giving the dividend out just to take the share price high. So just looking at the dividend payout doesn't mean that the company's share is a good buy or not. You have to look at other indicators. In this example, I looked at the indicator that debt to equity ratio. Debt to equity ratio was really bad, and it was pretty evident how they are financing their dividend. They are just taking the debt from the banks and they're just giving to the retail customers or to the promoters itself. Remember, promoter is the biggest shareholder in the company. So basically, the promoter is pocketing all that dividend primarily into his pocket. And that's why he's giving that much dividend out. So looking at all these indicators in marriage with the other indicators is very important. See you in next video. Bye.